Good evening, everybody. I, Divya Jain, on behalf of Indian Angel Network, welcome you all to Chai at IN. Chai at IN is a series of masterclasses that aim to provide comprehensive insights to young entrepreneurs, early stage startups, and business enthusiasts. Each session is conducted by industry stalwarts and explores various aspects of the startup ecosystem, ranging from validating business ideas to building brands, term sheets to successful fundraising strategies, and more. There are so many financial fires to put out in any given week that it can be hard to find the time to do any short or long range financial planning. But failing to plan financially might mean that you are unknowingly planning to fail. Business budgeting is one of the most powerful financial tools available to any entrepreneur. Simply put, mainly maintaining a short and long term financial plan can enable you to control your cash flow instead of having it control you. With this session, Indian Angel Network, in association with Amazon Web Services, AWS, and academic partners IIM Bangalore and SRCell, brings you this one of a kind opportunity to learn the art of preparing financial projections. I would like to invite Shivam Dang from AWS to say a few words. Shivam, over to you.
Thanks. Thank you so much, Divya. I hope I'm audible. There's a lot of echo because I'm
Yes,
sitting in an idle room, so please ignore that.
yes, you're
Hey
audible.
guys, hello everyone. Thank you so much for joining in. I'm part of AWS, and AWS is a cloud technology platform. For those who don't know, we provide technology solutions for your tech infrastructure, right? Ranging from using a simple storage to using as advanced as artificial intelligence and machine learning. Everything that you need is available on AWS. The reason I wanted to we wanted to do this with IN is because we want to provide to the startups beyond technology. And this is one of our endeavors on how do we go beyond technology and help startups grow their businesses in different aspects of their journey. I'll not take a lot of time, just wanted to reiterate the fact that if you have technology requirements, if you want to connect with AWS at some point of time, feel free to reach out to me. We've got startup programs that can help you offset the cost of building onto cloud. We've got programs where we can offer you credits that can help you build on your technology without incurring the cost of cloud. We've got programs where when our tech experts can sit with you, they can advise you and guide you in terms of how do you go about building a robust architecture. We've got account managers who will be working with you and will be part of your journey. And whatever you need on a day-to-day basis, you can reach out to them, brainstorm with them, and seek support. Right? We've got a vast third-party network as well, wherein these third-party partners can help you implement your technology requirements if you do not have an in-house tech team, right? So anything that you might require, we're trying to build startup programs around it. So feel free to reach out to me, after this webinar through IAN or directly as well. You will have our email IDs too. And let me know if there's anything that we can do. And once again, thank you so much, Ian, for bringing all of us together. And thank you, panelists, for taking out time for doing this for us. Thank you so much.
Thank you so much, Shivam. Join me in welcoming our esteemed speakers, Mr. Priyank Garg and Ms. Ratna Mehta, who will share their insights on the basic of financial planning. Mr. Priyank Garg is the Joint Managing Director at Advanced Vaults. His thrust is on scaling up existing businesses and looking at emerging businesses to diversify the group activities. At Advanced Vaults, he has launched innovative patented products, new systems, and processes, and brought new skills and talent to the organization. His strong technical background and ability to understand and provide direction to large complex systems has enabled him to lead large cross-functional teams. He has previously led Yahoo Search Technologies, the brain behind the Yahoo, Searchbox as director, product management before he returned to India. And before that, worked in startups and Deloitte Consulting. He has done his BTech in CS from IIT Delhi and MS in CS from Stanford and carries an innate curiosity about deep tech. He has invested in over 50 startups as an angel investor over the last 15 years, including well-known names like Myntra, Druva, Unifor, and engages in hands-on startup mentoring across diverse sectors in ventures at the seed funding stage in India. His current portfolio comprises active investments in over 30 ventures in India and abroad. Welcome, sir. Ms. Ratna Mehta is a
Yeah,
private, yes, sir. Ms. Ratna Mehta is a private equity investor in 20 years with 20 years of experience across growth, buyout, and early investing, consulting, and banking. Based out of Mumbai, Ratna heads the Vadhwani Catalyst Fund, which invests in high quality entrepreneurs with scalable business models and programs with overall objective of accelerating economic development by creating jobs. Ratna has a diverse experience spanning the entire cycle of investing, portfolio turnarounds, and exits across multiple investments. She has been on board of various portfolio companies, driving overall strategy and growth. She is also a board advisor to various startups and an active member of various entrepreneurship networks. Welcome, ma'am.
Thank you, Divya, and good evening, everyone.
Attendees, please note for any question that you may have, please write them down in the chat box or in the question and answer section, and we'll take them at the end of the session. Without further ado, I hand over to Mr. Priyank.
Thank you, Divya. Thank you very much, and thank you everybody who's here. We have 100+ people, so great to see an audience who's curious about the topic. And thank you, IAN and AWS, for putting this together. So while I start my presentation, I want to give you a little bit flavor of my background and how it. I mean, you heard my bio, but I want to share what I think that makes my perspective and what perspective I'm making this presentation from. So I have a few slides. It's not a lot, but the idea is that I have, over these 50 years of 50 startups that I've invested in, seen, God knows, 400 different presentations and so many entrepreneurs. And I have felt the need in this audience of some basics and some structure around thinking about money, which is what I'm trying to communicate through my presentation. I have had no formal training in finance. I have not taken any online courses. I've just learned the hard way by taking the real knocks in running a business or running a product. And what I've tried to do is distill my thoughts or my experience to very quickly get us all on the same page in terms of basic fundamentals. Of course, many of you may already know this. Some of the audience may be skilled in finance. Some of you may have learned it like me by experience. But I've still found, when I've previously done a conversation like this, that setting this basic ground rules and getting this fundamentals out with everybody actually has helped bring clarity and bring the conversation forward. So hopefully I can give a common platform for all of us to have Ratna's presentation where she can really blow your minds out with what she has to say. So I'll start with a very simple analogy of your business, right? If you're a startup, think about yourself as your household and as a household. What do you think about when you look at your company's balance sheet, your assets and liabilities? It's basically your own personal net worth equivalent, right? What is the net worth of the company? What is it that you have and what is it that you owe? That's essentially what the company balance sheet is, and that's just like your household net worth. Similarly, if you look at the cash flow of a company, it's basically just like your household budget. What cash you got in, what cash you spent. I mean, this is all nothing new. Most of you probably know this, but have you ever wondered what the profit and loss looks like in a household? I don't know what it looks like. There is no profit and loss in a household, right? It's only balance sheet and cash flow. And the reason is that profit and loss can sometimes be unreal. Like, for example, a very profitable company can go insolvent. I've seen it happen to my startups. I've seen it happen to companies I've been part of. You can have negative cash flows due to high receivables or inventory and very low payables that can create you, while your books show profit, you never have the money to keep running. Or you have high expenses, say R&D expenses, which are not expense but capitalized. And so your books say you're a profitable company, but you don't have the money to continue tomorrow. Similarly, a loss-making company may continue to grow and prosper, right? You can have a highly positive working capital cycle. Well, money is paid in advance, inventory can be paid later. Or SaaS, you pay up your entire subscription model for the whole year, and then the service is coming later and the expenses are incurred later. So the money comes in first, the expenses are later, and so you might always have positive cash as long as you're growing, even though you're on the books making a loss. Or you may have other sources of cash, like equity, as you can always do with funding rounds. You may be still loss making, but you can continue to grow and prosper. The point is, I've seen a lot of entrepreneurs get stuck or surprised by the working capital cycle. People who have not been involved in finance or operations sometimes are surprised that I have a product that I'm selling, revenue is going up, and yet I don't have the money to pay vendors or do things, because this working capital cycle of receivables that are piling up in the growth phase can sometimes leave companies strapped. So essentially, the point of this basic introduction that I'm trying to share is a profit and loss is an artifact of the accrual method of accounting and an artifact of taxation, whether rules set apart by the government or regulatory bodies. It's actually not necessarily what is the reality of cash on a daily basis. And that's why one needs to really think about what is your operating cash flow. If you look at operating cash flow, one often asks, is that EBITDA? So if you take profit and exclude financial costs, including earnings, include your taxation and external elements which are out of your control, which is the T, include your capital investment effects. You invested in something, it's depreciated, you need to replace it. So it's not really operational really changes, but just overall asset management activities. And sometimes in a company like a SaaS company, you may have revenue recognition effects like amortization, etc. And that's what gives you EBITDA. So the earnings before interest, tax, depreciation, and amortization. All of your investors, when you want to present to them, probably ask you what's your EBITDA. The point is it represents your cash margin being generated by your operating model. What is the net cash that's coming into the company when you take away the effects of finance, assets, taxation? And essentially, it is almost like EBITDA plus the changes of working capital, which gives you your operating cash flow. Now, once again, I will give a disclaimer. This is an entrepreneur's view. This is an investor's view. This is not really a professional's view. So wherever I am off technically, please consider it, simplification for the purpose of communication. I mean, I'm not trying to get the whole concept technically correct. I'm trying to share what I feel are the tools that the entrepreneurs and the incubators and investors in this audience may find useful when looking at a startup and doing financial projections. So all of this basic stuff, some of you wondering why I'm talking about it, that's the main question I wanted to come to. For this, should you forecast when you're doing financial projections? Should I forecast cash or profit? I mean, a young person starting out on their own, cash determines the future. You need to get enough cash for your daily existence while a business model is established. And any surplus operating cash, you would be investing to build back in the company, whether you're buying things, whether you're buying machines, equipment, computers, offices, furniture, whatever. Intellectual capital in terms of IP or other software or other product development activities, and then human capital, bringing in people who have skills, developing them and investing in them and making that knowledge that's in the company that's going to make it succeed in the future. So that's why you need to really focus on the cash. Financial projections should be focused on cash in the first few years of a startup. Operating cash flow is key. If you do not know your operating cash flow, all your rest of the models may work well, but you may be totally surprised what comes and hits you. And along with the operating cash flow as the primary, of course, you should look at the profit, in particular the gross margin and EBITDA, so that you know what your future looks like. If you are a profitable company, then in the future, as your revenue grows, if your gross margins or EBITDA are good, then you will be then you will know when you are actually able to fund yourself and continue to have a successful business. So the profit and gross margin need to be projected, but the initial focus starts with cash flow. Now on to the second topic on this whole dimension that I feel can help our conversation for the rest of the hour. Gross margin. Why gross margin? What is gross margin? If you take revenue per unit, which is a unit selling price, and you subtract your cost of goods sold per unit, which is the BOM cost, bill of materials cost for making that product, labor and process cost to make the product, logistics and development deployment costs. You may have to go somewhere to do installations or commissioning or shipments, etc. That becomes your basic cost of goods. This is usually the definition for some sort of a manufacturing type of environment. But of course, if you go, the same definition can be expanded to include other kinds of delivery costs, like say product operations costs. In a SaaS environment, you have AWS or other hosting services or other continuous costs. Maybe you have a product operations teams, your DevOps, maybe your product ops, etc. So all of those become part of your delivery costs. They are probably in accounting as part of COGS. I'm just trying to bring out the ideas here. And then, of course, your after-sales service. So what is the service cost per unit? So that all of that put together leaves you with the gross profit. That's how you get to your gross margin. Gross profit by revenue is your gross margin. Now, why is this such an important topic in my mind that I bring it some front and center? Gross margin for basically, gross margin is after all costs that grow linearly with revenue. So as you sell more, these grow. If you sell 10x, all the costs grow 10x. If you sell 100x, all the costs grow 100x. Of course, you may at some point, make some design improvements, make some process improvements and reduce your labor cost and process cost or reduce your BOM cost. Or you may change your sourcing strategy based on volumes and get a lower cost of some components or some services. But the point is, if you don't change anything and if you just sell more and more and more, you will end up having 10x revenue, generate 10x gross profit. It will be linear. Just one point again, of course, in the case of a software SaaS business, your cloud hosting cost may be the primary cost element of your gross margin, unlike in a manufacturing environment. Ultimately, the main point of the gross margin is the linear relationship of revenue and the costs. Why is this? How does this compare to unit economics? SaaS companies use your unit economics more often. Of course, non-SaaS companies can use the same as well. And unit economics is defined by two main terms: your customer lifetime value or your customer acquisition cost. One of the definitions for customer lifetime value I've shared over here. You take the number of transactions times the order value and the average customer lifespan times the gross margin, not the revenue, the gross margin. That gives you the revenue per customer. And then similarly, the customer acquisition cost. So how do you look at both of these? The point is that in the early phase of a company, when you are defining or developing or establishing your minimum viable product, gross margin is very important. You need to really be sure that you know what it takes to make and deliver the product that you are bringing to market. That's why it's called the minimal viable product. Of course, there's viability in terms of capability for customers. So MVP is not just financial viability, but viability also includes the financial viability. And so in these early stages, your CLTV and CAC, etc., are not very established. So your unit economics are not necessarily very clear or relevant. But later in a post-revenue stage, when there is a product being sold regularly and you have more data and more transactions and more history, then unit economics become a better focus point, because as you can see, unit economics essentially brings the additional validation of your go-to-market strategy. What is the way you get to customers? What is the way you get them to buy? And that go-to-market strategy and how you layer it on top of your gross margin. So the gross margin, which has earlier given you your business model numbers, and top of that, you add the go-to-market strategy in terms of your unit economics of CLT, of your CAC, and that gives you your unit economics. So it kind of builds on top of the business model. So the relevant question is, what is a scalable business model? You all want to know, how do I know if my business model is scalable? Or how do I communicate? If you already know it's scalable, how do I communicate to others that my business model is scalable? I mean, you can look at the numbers again and just have a quick understanding. Gross profit, number of units times gross margin, minus your marketing, sales, R&D expenses, your R&D operations cost, your general administrative, which includes your HR, admin, facility, IT, including all of the management team probably, unless you're directly involved in, say, selling or, you're making the product. Finance cost, which is, of course, the interest. All of this gives you your net profit. So the point is, all of these above expenses, which are beyond the gross margin, are non-linear with revenue, except maybe your customer acquisition cost, because the same team, once the product is developed, the same product can be developed to 10 customers or 1,000 customers, as long as it, of course, is built scalably. But the R&D team does not have to go 100 times to go from 10 to 1,000 customers. So the ratios are not linear at all. They're sublinear, and therefore a high gross margin means that as your number of units increase, your net profit keeps growing because your overheads don't grow as fast. So essentially, a high gross margin indicates scalability of business model. This is one of the simplest learnings that if founders or entrepreneurs trying to raise funds would very clearly bring out in their presentation, would get them across so many different hurdles in their fundraising cycle, that I just feel this is something that I want to bring to your attention and ask you to ponder over it. A high gross margin is the biggest indicator of the scalability of your business model. And I'm not talking about replicability of product or other aspects of your business or the proposition being scalable, but just the business model itself. That scalability of that is directly correlated to the gross margins that you have. As the revenue grows, net profit grows. And so anybody who looks at this can say, well, they may be making a loss today, but when they are making 100x, they'll be making a lot of money. And that's what it is, that's what makes a business model scalable. And that's why software businesses are so scalable and such a darling of investors, because when you have software businesses, they have a very high upfront cost in the R&D and the initial marketing and sales. But then when the revenues kick in, the gross margins generate huge profits. So essentially, the whole premise of the VC model is, or originally has been, that an outside investor or a venture capitalist comes in, funds the negative EBITDA of the development phase of the product. But because the gross margin is large, as the business grows, it pays back very quickly in high profits. So that's why now coming to the point of the topic of the day, financial projections. What margin should you be focusing on? So the best financial modeling of projections that I've seen companies do is when they start with the unit or a customer level projections. Work hard to get the gross margin right, to validate the business model, and then take the CAC and CLTR or CLTV, customer lifetime value, to understand the unit economics given by your given your go-to-market strategy. So once you spend a little time zooming in at the unit level and you understand these details, you are able to get some of the key determinants, key measures of A, your business model and its scalability, and B, the effectiveness of your go-to-market strategy. And then you take it to the company level. You derive your operating cash flow from the unit numbers by adding your overheads. You derive your EBITDA from monitoring and ensuring that you are going on the right path, improving your model's validity as you scale up. Remember, when you get to operating cash flow and EBITDA, your overheads are also part of it. So you may have high overheads, and as your revenue goes up, the EBITDA starts going up, or less negative, should we say. And then at the company level, what is also very important is you need to really pay attention to what one could call your net worth or balance sheet enhancing activities. What are the investments that you need to make in your R&D or in your capital assets to get where you need to go 6 months, 1 year, 2, 3 years down the line. And so that total gives you a full view of the cash needs of the company. And of course, in any financial projection, anybody who's worked with you on any model, just like in any tech simulation, clearly identify and document all the assumptions that go into your model, so that when you, as you revisit them, revalidate them, learn something new, you can review and update your model very, very quickly. So that's my quick summary of what is it that I think can set us on the same page in terms of financial projections. And I hand it back to Divya and Ratna to add to the evening's conversation.
Thank you so much, sir, for an insightful session. I would now request Ms. Mehta to walk us through the next part of the presentation.
Thank you so much, Divya. Uh, Good evening, everybody. Thank you so much for taking this time out for this session. Indian Angel Network has a great network in terms of getting people together, and I think it's a pleasure being on this panel. Priyank actually took us through the very basics of finance, right? That how do you look at revenue, operating cash flows. He like very rightly highlighted some of the KPIs which should be on any entrepreneurs, any startups radar in terms of tracking, right? What I am going to do today is help to peel the onion one more layer and give some insights, or try to give some insights on when you are looking at your business model, what are some of the things that you should be looking at, and how you should be thinking of building your business plan. Because as a startup, as an entrepreneur, right, it is very important for you to budget what you're going to achieve, to budget what do you need or what are the costs that you're going to incur for achieving those things, and then be able to track that, be able to convert it into key performance indicators and track them. Because during your journey, there are going to be ups and downs. And some of these indicators will be lead indicators in terms of telling you that something is going right or something is going wrong. And this is how you should pivot, or this is what you should keep in mind while running your business. As they say, if you have a dream, just jump into it, do it, take the first step and go for it. And the best thing about entrepreneurship is that an idea without execution is hallucination. And therefore, the whole aspect of putting together financial projections, keeping an eye on tracking those is very important, because that's part of execution. A lot of you might be at stages where you've thought of an idea, you've thought of a product, a strategy, and now is the time to kind of put your hands together and execute. And the first step for execution, right? The entire execution plan, if you have to put it together, you have to basically convert it into an Excel and then be able to thumb the table and say, yes, this does make sense. And therefore, when an entrepreneur, a startup looks at their business, I always see it from the perspective of 4 M's, right? You evaluate the market top down to understand what is the size, what are the growth, what are the trends. Then you look at the business model, the basics of which Priyank spoke about, and the next level of converting those basics into how do you project your business is something that I'm going to talk about. The third is, of course, the management, the people that make the business. And the fourth M stands for money, which is basically that after analyzing your market, if you think that you have a business model that works and you have the right people to do it, how much money do you need? And the financial projections will also help you to decide how much money you need for that. Divya, if you could just go one slide down. Right. The basic things like revenue, costs, gross margin, operating cash flows, your CACs are some of the concepts that you need to understand, right? But when you have a business idea and you're trying to convert that business idea into financial projections, the first thing that you should convince yourself on is unit economics. How do my unit economics stack up? Are my unit economics positive? And therefore, the importance of gross margin, which Priyank spoke about, right? A lot of entrepreneurs, a lot of startups, when they start talking to investors will want to know what are unit economics. So what is unit economics? right? If somebody asks you, what is the unit economics of your business, right? Let's take an example of a consumer product company. Let's take an example of a skincare company, for example, a Mamaearth, right? They, of course, have multiple product categories. So for the various product categories, your unit economics will be different, but assume that this is a startup, you're starting off with 2 or 3 product categories, but you need to know exactly well how your unit economics stacks up, which means that what is the cost of producing that product? If you see in my table, we have the revenue per unit, which is your MRP. We have the cost per unit, the variable cost per unit, which is the cost of manufacturing, which means the direct costs which are related to bringing the product in its form where you can sell it to a customer, which is your variable cost. It doesn't consider the fixed costs like rents, utilities, salaries, etc. You need to have a real hold on this. And having a hold on this will also help you improve your product margins. For example, if you are contract manufacturing it and getting it from a vendor, your objective, right? For example, here you are seeing that you have a product gross margin per unit of 300 on a revenue of 500. Your objective should be that how do I take this 300 to 325 in year 1 to 350 in year 2 and so on and so forth. Every business will have different gross margins. Like for example, IT has very high gross margins. Retail will have lower gross margins. Consumer product companies can have gross margins in the range of 50 to 70%. When we talk of high-end brands could have 70 to 90% gross margins. So essentially, what business you choose, you need to understand what are the gross margins and they accordingly have the fixed cost. Once you have your variable margin, right, which is your gross margin, beyond that, you look at your fixed cost, because your most important thing as an entrepreneur is to understand that when do I break even? Break even means that no profit, no loss kind of a situation. So you need to understand that I have certain fixed costs. I pay a certain rent, I pay a certain salary. I mean, depending on the number of people that I require, I have certain utilities costs, etc., which is your electricity and all. So generally, these are the 3 broad heads. You tell yourself that I have a fixed cost of 1 lakh, 2 lakhs, or say 6 lakhs per month, as in my example, right? And then you decide that what's going to be your break-even units that you need to sell. So you take your fixed cost and your break-even, and you compare it with your gross margin per unit, correct? So you have 6 lakhs fixed cost and you have a gross margin of 300. So what will be your break-even units? You will get that number. And then your aspiration should be that month on month to go and reach that number. And once you reach that number, you will be EBITDA positive. And beyond that, you will decide how much money more you want to spend to increase your revenue. So this is a very important landmark for early stage entrepreneurs, for startups, right? Because generally all investors, if you are fundraising, all investors will ask you, when are you going to break even? What is your break even point? How many units do you need to sell to break even? So these are the things which you need to understand, that to get at 6 lakhs of gross margin divided by 300 per unit, you will need 2000 units, right? And then you can decide, you can determine your cash flows based on what is your estimated sales per unit, right? So this is pure understanding of unit economics. This is not even building your financial projections, but before you start that, you need to have an understanding of this, right? And therefore your variable costs, your fixed cost, etc., you need to stack it up accordingly, right? Also, what is payback period? What does payback period mean? Payback period means is that the total initial capital that you require for your business and the operating losses, if any, that you're having over a period of time, how many months will you need to be in business to be able to recover the initial cost? So if you see my table on the right hand side bottom, if your initial total cost on plant, because I've taken an example of a manufacturing company, consumer product companies can be manufacturing or contracting. Here, assume it is manufacturing. You will basically, and if you're spending 60 lakhs, right? 60 lakhs, and if you're having a pre-tax cash flow per month of XYZ, which is your C, your payback period will be your D divided by C, which is your 60 lakhs divided by 3 lakhs. So these are very basic concepts on take even and payback. And for understanding those concepts, you need to understand what are your variable costs, what are your fixed costs, and how much initial capex are you incurring. Divya, just swipe down one more. Right. A very important thing, right, for any entrepreneur to convert your idea to execution is being able, first, to develop your idea. Second is to decide your strategy around it, your product strategy, your people strategy, your marketing strategy, etc. And then convert that into your financial model. A lot of times, what I have seen during my experience, because we generally look at least 5 to 10 startups per week, is that a lot of people have great ideas, but when it comes to converting it into a viable financial model, that's where the gap is. They don't know how do they do that. For example, if you talk about edtech is right now buzzing. Everybody wants to create content. Everybody wants to reach new consumers, tier 2, tier 3 markets. That's where the meat is, right? But if you ask them, overall, what is your content creation cost? How are you going to reach your consumer? What is your go-to-market strategy? Go-to-market strategies means how are you going to source your customer? How are you going to get your customer? Is it through digital marketing? Is it through platforms? Is it through business-to-business tie-ups, which basically means that you tie up with other platforms to get your customers, right? That is where the gap is. And then converting that, saying that if I'm a B2B player versus a B2C player, business to consumer means you're directly reaching the consumer. So for example, Beju, okay, if I have to give you an example, is a direct to consumer player. And Beju, if Beju goes through schools, which they do also, then it is a business to business player, means it is a B2B2C, means Beju goes to schools, and the schools, through the schools, they reach the students. And they also directly reach, like a White Hat Junior directly reaches the students, right? So depending upon your strategy, your CAC will change. So the important part is to analyze your go-to-market strategy, your customer acquisition costs, which depends upon your go-to-market strategy, right? So for example, in a go-to-market strategy, if you take a consumer product company can either build up their own distribution network, or they can do a mega distribution. Like they will appoint one distributor, and then that distributor goes deeper into the market to reach the retailers. So that your cost, the resources that you require, all of that will depend upon what strategy you are using. For example, if you are, I'm just giving you real-time examples so that you understand how to convert it into a financial model. For example, if you take HUL versus PNG, HUL has always used the strategy that till the end retailer, they will reach directly. So even though they appoint distributors and sub-distributors, their sales team does the entire tracking, that at the depot, at the distributor level, at the sub-distributor level. So a distributor margin will be 10%, a sub-distributor margin will be 5 to 7%. A retailer margin is, say sub 10%. So their total distribution cost itself is about 20, 30%. Versus that a pharma, if you take a pharma distributor, gets only about 8%, right? And a retailer gets about 20 to 25%. So overall distribution cost, which comes out from your net sales. So if your MRP is 100, that's your gross sale. Then you have your distribution margin, and then your net sales become 70 if your distribution margin is 30%, right? Versus that, a PNG, what a PNG does is a PNG just appoints a mega distributor. Say for the state of Maharashtra, I appoint one distributor. For the state of Gujarat, I appoint two distributors. And my overall distribution cost will be 20% for that guy, because he then needs to set up the entire system below him, right? So that's how you will convert your strategy into your financial projections, right? Again, when you come to customer acquisition costs depends upon whether you're business to business player or you're a B2C player. In a B2C player, if you're doing online, depending upon your SEO, the Google ads, depending upon your conversion rate. So for example, if your conversion rate is out of the 100 leads that you get, if your conversion rate is 1%, 1 or 2%, a very good conversion rates for most people, then accordingly you will say that this is the amount of money that I have spent on marketing. I will get 1 lakh leads from that. From that, I will get 1,000 customers. So my customer acquisition cost is going to be, say, 5 lakhs, because 5 rupees per lead. I'm just making some assumptions here, divided by the number of customers that I get, correct? Similarly, your organization structure, I'm taking the big costs over here, right? I took marketing, right? I took distribution costs. Now I'm taking the people cost. Very, very important. Most startups, most entrepreneurs whom I talk to these days, what is their biggest problem? We don't have the right people. Where do we get the right people from? How do we retain the right people? So people, being able to source the right people and attract the right people are some of the key issues which startups and entrepreneurs are facing today. And therefore, you need to decide your organization structure, decide that at each level, what type of people you will require, what will be their cost, and accordingly budget your salaries. Because rent, of course, is much easier than the rest of the things, because you will know if you are doing a retail strategy, you will know where you're going to set up stores, etc. If you're having a corporate office, the rent is not a big number. But if you are having a distributed model where you need several locations across the country, then rent also becomes very important, right? So depending on these things, you need to convert that into your financial model. Divya, just go down one slide. Right. Now coming to the building blocks of the financial projections, right? How do you estimate? Now, Priyank spoke about what is revenue, what is gross margin, what is fixed cost, and how does your balance sheet stack up, right? Your sources of funds and your uses of funds, as he spoke to us in relation to a household, which is much more easier to understand. When you're projecting your revenue, right, how will you project the revenue? Most of the entrepreneurs at an idea stage struggle with this, correct? So the top-down approach to it is saying that overall my total addressable market, TAM, which is basically the lingo that is used for financial projections, you need to understand that. So for example, let's take a healthcare example, right? You are setting up say some women's health product. You're setting up an app for a women's health product, right? Then you need to understand that which markets are you going to target? Are you going to target the top 10 cities? Are you going to target the whole of India? Or are you going to target tier 2, tier 3? Going from there, you see that what is the population relevant to you? I'm going to target my customer who's 18 to 40, right? In this age group, there are so many people. Then you say that from this, my target is to get 0.1% or 1%. And how will you understand that? You will see other players in the field who have gone through this journey and say that, okay, their customer base must be this much. They've reached this much in so many years. I will be able to do it year 1, year 2, year 3. And therefore you say percentage, these many customers. And then you have your realization per customer. Your realization per customer will come from your unit economics. So that's how you will build your revenue. Say your realization per customer for an app Your monthly subscription is $200, 200 into, average, you're assuming that for a year they will do, or for 2 years, or on a monthly basis. You take your realization, multiply it by your customer base, and then you decide your revenue. And your marketing will essentially depend upon how do you target those women in that age group in the cities that you have decided to go to, right? That's how you will determine your revenue. Your variable cost essentially depends upon the sector that you are in, what is your product. Essentially you should make sure that you're optimizing the cost over here. So basically, if you are in edtech, or you're in a consumer product company, or you're in a healthcare company, for example, if you're a hospital chain, right? More or less, based on your experience or based on competition mapping, that this should be your margins. So when you are deciding what's your variable cost, you should ballpark be in that level and then try to better it. Fixed cost, of course, we spoke about. Most key legs of your fixed cost will essentially be your salaries, your utilities cost, etc. And you will be able to project your fixed costs based on the model that you are using. And then comes the balance sheet, a very important thing, because all of this will not make sense unless you have the funds for that. So whether you raise initial equity from friends and families, you go to angel networks like Indian Angel Network, you take debt from the company, A will depend upon the stage you are, B will depend upon the ability to finance your business. Some businesses get financed at an initial stage. You have another category of financing, which is venture debt, that has come into play right now. But as we have popularly seen, angels, friends and families are the initial investors, and they help you kind of fund your business at an initial stage. Correct? That is on the sources of funds. On the uses of funds, of course, your capex will determine your fixed assets. Your working capital cycles will determine your current assets. So basically, if you are a consumer product company, you know that you generally need 1 to 2 months of inventory. There is no receivables. In some businesses, you have high receivables. So how are you going to fund those receivables? Those are some of the things which will help you build your business projections, right? But most of that, once you have your business in place, the CFO, the finance controller will be able to do that. But the key thing is your assumptions around your revenue projections, right? Those are very, very important. Yeah, I think that's pretty much in terms of going to the second level, right? Priyank really gave us the basics about, the P&L and the balance sheet. And I spoke to you about linking that to your business, right? How do you think about the financial KPIs and convert your business strategy into financial projections? I really do hope that some of this has helped you, and we're very happy to take questions from you to, answer individual doubts or individual queries.
Thank you, ma'am. Thank you, sir, for your insightful sessions. Proceeding with our Q&A session, the first question is, if a company came into being in June 2019 and hasn't done any business since then, what assets, liabilities, and cash flow can they show? Can they still apply for a fundraise or not?
Well, one can always apply for a fundraise. If you have a great idea, there's nothing wrong with that. If the company has not done any activity, I think everything would show zero on both columns and on the P&L, right? So it's essentially just a non-started event. So I don't think what you look at is your financial statements. You look at what your forecast and your plan is and how you convince the investors whether you can achieve and execute that plan. First, you have a good plan, and second, that you can execute it.
Yeah.
As Ratna said, idea without execution is hallucination. So bring both and you can get funding.
Yeah, I mean, see, the whole thing is that there are different categories of investors that you target at different stages, right? On a pre-revenue, it's called a paper plan funding. Basically, the guy will back you and will back your paper plan, right? Once you have some MVP, as they say, then the investor will start looking at the MVP and say that, is this viable? What is the potential of this product? Once you have revenue, then you start basically seeing what's the growth. Actually, the common joke within the investor, within the startup circle, is that you basically go and raise funding before you become EBITDA break even, because then once you become EBITDA break even, then you have to show that trajectory continuously.
Okay. At MVP stage for a digital platform startup, that is, how can we estimate gross margin when the tech is still being built by the founder? As in, the gross margin would be high initially. How do we estimate?
This is
gross
a very
margin?
important point, and sometimes people get very surprised or confused as to my gross margin is coming at 85%, 90%. That is very viable in a software product. Why is it? Because you take a team of smart people and spend hours and months building a minimal viable product, but that one-time effort gives you revenue for many, many times if you have a good product market fit and if you have a go-to-market strategy. So don't be surprised if in a software company you have an 85% gross margin. Of course, Ratna gives some very good examples of a company like PNG. They will not have that. Marketplaces will have single-digit gross margins. Manufacturing companies will have high teens or maybe tweens, like 20s or 30s in a good business. And so the gross margins vary by business a lot. But why the gross margin is very high in a software company, even though it looks like you're spending a lot of money on whatever team and the founder effort, is because that effort one time can be leveraged hundreds and thousands of times if you have a replicable product that can be sold multiple times without having to, every sale being having to be hand carried by the founder to success. So if you build a product that can be replicated, you can have high gross margin. So look at what it takes to actually deliver the product from the order stage to customer revenue being realized. Realized being the sense meaning customer accepting that what you promised him, he got. So if you need an AWS hosting, or if you need distribution, like Ratna gave the example, if you have a distribution chain, whatever those costs are for every sale and revenue, that is what goes into a gross margin. The development cost may not, as long as it is going to be used hundreds and thousands of times.
Right. Okay. Some investors say that a non-linear growth is a sign of a scalable business model, and more focus has been placed on your go-to-market strategy. Can this be addressed by showing a high gross profit margin?
Yeah, go ahead,
Ratna. See, a high gross profit margin business is always more attractive, right? Whether your growth is linear or not doesn't really matter, correct? Even if you are having a steady growth, it is a good sign. Very high growth could be due to a certain event or a situation, which is good. I mean, who doesn't like growth? But if it is not sustainable, then it could get questioned.
Yeah, and I also do want to say that I'm not saying gross margin is the only way to show a scalable business. The point is, gross margin is the way to show sustainable, scalable business model. But if your go-to-market strategy is giving you very high growth, that is a very strong indication of a scalable business. That if you can quickly get to market, quickly capture and create revenue, so that's a different dimension of scalability of the business. And business includes go-to-market, business model, and many, many other things. So that's the way I would think. These are not either or. I mean, as Ratna said, a gross margin always very, very high gross margin, always more attractive than low gross margin, and high growth go-to-market strategy always more attractive than low growth go-to-market strategy.
Priyank, in fact, I would say that if it is a low gross margin business, and I work with a lot of pharmacy chains to know this, you need scale. So you have to quickly decide. You need scale, because when you operate on thin gross margins, your margin of error is very low.
That is exactly true. So in fact, what you're communicating is that the high growth rate is even more important to illustrate when you have a low gross margin. So you're right. Agreed with you on that. Understood.
Okay. Our next question is, what should be the level of granularity of a business plan for angel round or a pre-seed round? Does business plan matter till we have launched the product, or if PMF has still not been established?
Well, I mean, the business plan is the plan, right? How are you going to have success until you know where you're going? And of course, you may change, you may pivot, but until you start from a good plan, then there is no path to go, right? As Napoleon said, it's not the plan that matters, it's the planning. And when you come up with a plan, that tells you whether you are doing something that can likely succeed, and then you have a chance of convincing others to offer you money. I mean, so business plan definitely matters, no matter what you are going down the route. PMF, product market fit, is often not established. I would always say PMF is established only when the product is in the market and revenue is achieved. So a lot of funding is pre-revenue. That doesn't mean PMS has to be established before revenue or angel round can be raised. Of course, but you do need to have a good plan that somebody can buy, that you and your plan can be a success.
Okay, so this gentleman asks, practically, if margins are high, so will be the competition, and gradually margins will normalize. B, as we scale up, margins will normalize. The query is, what would be the ideal way to consider present margins or industry benchmarks for making financial plans for the future?
You want to take that, Ratna?
Yeah, so if you have abnormally high margins, it's an economic theory that other players are going to come in. And therefore, it is very important in whichever industry you are. See, I mean, we assume markets are efficient. And when markets are efficient, people are going to realize that these segments are very interesting. Correct? That is when the gross margins overall will normalize. So I don't think that you can have abnormal margins for too long, right? Or that you've hit upon a gold mine or something like that. So those are very rare situations. Normally, any businesses that you're thinking about doing will have rational gross margins, but that is when they say, right, that your business needs to have a moat, right? And the moat could be a brand. The moat could be the location that you choose. The moat could be your pricing. So some moat has to be there, and that is how you will sustain your gross margins.
Yeah, exactly right. I would just want to say, I mean, all the modes that you look at, they in some way ultimately help you protect your margin, right? A brand makes your CAC lower. Your low cost operations may make your gross margins better because others are not able to replicate it. Your network effects attract revenue without and scale up your realization. So that increases your gross margin. So all the types of mode that one can think of, intellectual property. Yeah, I mean, no one else can do what you're doing. So they're all about protecting your gross margin or creating a gross margin through less effort, however you look at it. So,
with respect to revenue per unit, should this be MRP or net what we receive after payouts have been given out to e-commerce portals, to the discounts that have been offered? For example, Amazon as a platform takes approximately 50% on MRP per unit. So what should be considered as the revenue per unit?
yeah, clearly it's about what you get into the door, right? Or you can consider it as your distribution margins, or you can consider it net revenue. Or do you have another way you think about this, Ratna? Because I guess there are two views, schools of thought on this.
Yeah, so generally the distribution margins are considered in the net sales. So you consider sales after your distribution margins. But if there are other costs like logistics costs or marketing costs, like then you take it, below, then you take it as a cost. So your revenue will be higher. But it also depends upon what revenue you want to show. Ideally, you show it as a cost so that your revenue is higher, right?
I mean, if you show it as a, if you do that, of course, you understand that your visible gross margin will reduce. Then, of course, your revenue is higher. So it's a trade-off. It's sometimes a matter of doing the same numbers in two different ways, but they have the different image.
Really.
if a company has both distributor and direct sell to customer models, how does the discount and unit price work? Example, if unit MRP is 100, distributor discount is 30%, what would be the direct customer price? Same 30% discount or maximum 20% to keep the distributor competitive? What do you suggest are the best practices here?
I'm not really sure I've understood the question, but if your MRP is something the customer pays that much only, your distribution margin, the customer is not bothered about the distribution margin. So if your MRP is 100, like an HUL product, take a toothpaste, right? If it is 50 rupees, your customer pays 50 rupees, your net realization is lower because of the distributor. Now, if you want to give a discount on that, the discount definitely comes below the line. It discounts comes as a cost.
I think the other aspect that I believe the questioner is asking is, if you're giving a distributor 30% discount, how much maximum discount should you give to your customers? Do you give them only 20 or go up to 30? Do remember that if you're expecting a distributor to create market reach for you, buy inventory, pay you on time, maybe help you market the product, fulfill it, then he needs to make margins. If you're not going to give him that space and you're going to give the customer the same discount as he's getting, then he'll obviously stop doing business with you. So if you have a channel and if you're developing a channel, remember that they're also economic players and they're also here to do business. So if they don't make money, they won't stay with you as distributor very long.
And it is very important that you have an aligned strategy. So you can't, can't sell something to your distributor at 70 and expect him to sell that at 100, and then directly you go into the market and sell the product at 80 rupees.
Yeah,
that won't go down well with your customer if that's what you're asking. I mean, with your distributor, and you are breaking your bridges.
Yeah. I mean, you can say that distributor, here's my maximum discount, and this is the price range that you can work in. So you may authorize him to sell, establish sub-resellers, or he may be directly selling, whatever it is. You need to keep your pricing very, very coherent across your channel so that your channel is working with you. You're not fighting it.
In fact, most good companies will always give a max, a number to the distributor that you can't sell it below this price.
Yeah. Yep.
How do you consider ongoing R&D costs for a software company, which will have future revenue potential? Do you consider them as expenses in the year the expenses occurred, or when they generate revenue in the future?
Yeah, I mean, so there are two types of R&D expenses, right? One is that is required to run the product. Maybe your ops backend needs to be kept up. Maybe there's some bugs, your server is crashing or something like that. That is obviously direct expense to deliver the product. But if you have expenses that are going to generate future revenue, then you are fully entitled to capitalize it as an R&D expense that becomes part of your investment and the IP you're creating. That keeps your P&L positive, that adds to your balance sheet in terms of adding to the asset side. But of course, do not ever be fooled that the cash doesn't stay with you. The cash still goes out the door. So manage the cash, but you can choose to, expense it in some ways. And if you are profitable, that can be part of your tax management approach as well. So this is somewhat of those, but the important thing is you keep a consistent flow or strategy across your company in a practice that is approved by the board, so that you're not changing it willy-nilly based on the situation every day or every month or every quarter. And if you long as you have a established accounting practice, I think variants of both are and somewhere in between are workable in many cases.
Right. For a startup, essentially bringing novel technologies, how must one build the assumptions for projections, considering that there isn't any relatable market space?
I think then it's a lot of doing basic consumer research and understanding that, what are the consumers going to pay? What is the pricing power? How are you going to, how many customers you will get? It's a little bit of a trial and error, to be honest, in that case.
Okay. How do we recover capex? How will revenue cover it, or how can we pay it back to our investors as they pay for capex, but it's not included in the MRP of the product?
Well, CapEx is covered in the MRP of the product. It's part of your gross margin, right? What you make in the gross margin, that has to pay for all your fixed costs over the years. So if it's not included in the MRP of the product, then you should revisit how you've done your pricing. You should be cognizant of what is the MRP and what is the price at which I will be able to recover the investment made now and in the future. And of course, that has to be a price that the customer is willing to pay. Otherwise, you will not get sales. But the point is, the MRP has to cover your CapEx over time, not immediately, not each unit sold, but over time it has to.
How do your financial projections impact a company's valuations? What are the specific factors that would affect this the most?
Everything, actually. What's your growth? What's your top line? What's your profitability? So essentially, okay, so if I have to distill it down, your top line, your growth, and your profitability will definitely decide a lot in terms of what your valuations are. Unless, of course, e-commerce or these online things, which they all work on GMV valuations, which is your gross market value. So you may not be making that revenue, but on your platform, if that much amount of merchandise is sold, then you get a multiple of the GMV.
And of course, only thing to add to that is what's the market size, right, that you are growing into. So apart from the financial projections of your particular model, how far you think that can be stretched, and that's a key part of your valuation.
Okay, here they say we are a healthcare startup. We just hit our first revenue from a peripheral product. We have given 50% discount on the valuation during our pre-revenue stage to be fair to our investors. Are we being unfair to ourselves, the founding team, or is it the norm with pre-revenue startups?
That's a very hard question to answer without the specifics. Too many unknowns in there. I don't know what I can say.
Okay, so I guess the one who's asked the question, you can just send us your deck and we can get back to you on this. The email ID is already mentioned in the chat box. With this, we come to the end of our virtual session on the art of preparing financial projections. I take this opportunity to express my heartfelt gratitude to Mr. Priyank Garg, to Ms. Ratna Mehta. Sir, ma'am, thank you so much for taking out the time to share your valuable insights with us on how to create long-term financial models, effective financial models. Your session today has been instrumental in helping young budding entrepreneurs learn how to manage their startup finances and to create a roadmap for future expenses. I would also like to thank Amazon Web Services for furthering IAN's mission of nurturing and strengthening the early stage entrepreneurial ecosystem in India. Last but not the least, I would thank you, dear audience, for joining in and making this session a hit. We hope you will tune in and join us for our next session, next masterclass in November. Thank you, everyone.
Thank you so much.
Thank you, Ian, and thank you, AWS, for the opportunity. It's great fun being here with Ratna and you. Thank you.
Thank you. Bye.